Welcome to Coleman Report Live. I'm Bob Coleman. We're talking Main Street and the small business lenders who help it grow. And we're with Katie Watucky, our editor, and Chris Hearn, founder, CEO, Fountainhead Capital out of Florida. Chris, welcome.
How are you?
Good, good. Looks like we're going to start having you in on Tuesdays, and we have a bunch of news that I will give you the tip of the hat to.
Okay.
We've attached it to the GoToWebinar dashboard, correct, Joseph? I see the handouts with five handouts. And it's courtesy of Chris, and I got that directly from who, Chris?
Chairman Rubio's office late yesterday afternoon.
And anyway, we're going to talk about that. And Rubio, there was a quote that just came over. I'm sorry, I'm paraphrasing it. Basically, he said, it's difficult, but it'll get done. So, so the handouts you have are the proposed guidance, the proposed legislation, and we'll talk about that. Let's go to our polls first, and then we're going to turn it over to Chris. Number one, do you approve of the new proposed guidelines or guidance? And that may be jumping the gun because this just came out, so you may not have had a chance to read it. And we'll ask the question later on. Yeah, okay. What do you think of those responses, Chris?
I think that's really smart that people said they don't know because, yeah, we don't know yet.
Do you know? Are you comfortable?
Yeah, I know what's been proposed, and we know that it's now August 10th, which I think I win the bet from last week between you and Lance on that one. But that's if they actually stick to that date and don't move it, but who knows? So we'll talk about some of it in a minute.
But what about you? We're going to talk about specifics, but do you approve of what Congress is working on?
I like much of it. I think it's a huge step in the right direction. I'm quite proud of what the Senate Small Business Task Force has come up with, but I am concerned about a couple things, which
okay. No worries. Number two, do you plan on offering a second draw of PPP loans? Which Katie, what's the acronym? I hear a bunch of things being thrown about. What are we calling this? PPP4? What are we calling it?
Well, it's very similar to the P4. I've seen a couple acronyms thrown around today. Not really one that's sticking so far, though. I think I've just seen completely different ones on all the different sites right now.
Well, I'm glad to see this, Chris. I'm glad that the industry is still embracing this. 2 weeks ago, we were talking about Main Street lending program, and looks like that thing's buried and long gone.
Yeah, that thing was kind of dead on arrival, and they kept tweaking it. And I think I read late last week the Fed had only purchased one loan so far, and I don't know how many have been made.
But again, my philosophy is I think that's fine. SBA is going to feed the market versus analyzing something to the death. And Chris, can you imagine if it took them 6 months to put these programs together and they're coming out with this in July 2020?
Well, I mean, I could imagine it because candidly, it would make our lives a little simpler in many ways because we wouldn't have as much
electricity. You live in a cave, right?
Yeah, I mean, it's I don't know. It's going to be interesting, and that's again one of my worries about the proposed legislation is I think again they're trying to there's a little more creative license in it than I think I would have hoped for, and I'm always been very pragmatic and think that they should try to keep it simple. Which is use what you got. You already have the 7A program. You got the framework. There's some proposed tweaks that I just think are going a little too far. That'll just add complications to everybody. But again, we'll talk about that in a minute.
Let's go to the third poll question.
And we're going to talk about this as just the PPP second draw loans. I think that's what maybe coalesce around that.
In the guidance, it's proposed that loans under 150. The exact terminology, Chris, is borrowers are not required to submit to the lender documentation required of the CARES Act, but must attest, i.e. certified, to a good faith effort to for compliance. So they're proposing 150, and that looks like that's the majority of our audience. They like the 150. I know there were trade groups that wanted 350 and some a little bit higher. How do you feel about the industry response, Chris?
Oh, I think it's good. I mean, I think as I've been saying for at least a month now, I think keeping this simple for the smallest businesses means that they don't have to focus their time and resources on this. Obviously, it does benefit the lenders some as well, which I'm supportive of, and I'm sure your audience is supportive of. But this allows the business owners to get back to work and not spend hours and hours trying to comply with the forgiveness calculations and documentation and whatnot. And actually, in the proposed bill, 150 to 2 million they're going to require. They've proposed a one-page certification. So, but below 150, there's just sort of the good faith effort that you spent the funds as you were supposed to. So that was a bit of a surprise actually for me to read that.
Great. And let's go ahead, Chris. Tell us what's going on.
Yeah, I mean, there's a lot. I mean, this is
You got 10 minutes. Go.
I will cover the high points as best I can. So again, for your audience, so maybe you all want to read this. Bob's given you the summary and the bill. It's a 92-page bill. The summary is only 7 pages. Some of the things that have been proposed, and keep in mind, these are proposals, so this has not been passed yet. This is not law. It will probably change. A lot of this is putting things out and trying to have a starting point on a lot of these things. That's how the legislative process works. So they've expanded eligible expenses to be used from PPP proceeds. So now they've added what they call operations expenditures like software, cloud computing, other accounting needs. They've included property damage that may have occurred due to the public disturbances that have happened over the last couple months that were not covered by insurance. They've included supplier coverage, variety of different things in that regard. They've also refocused their efforts or trying to restate the lender safe harbor, which I think everybody on this webinar will be interested in. They've simplified the application for forgiveness, and that's important to know. We just talked about that briefly, which is that borrowers will not be required to submit to the lender the documentation, but they have to make a good faith effort and attestation that they've done that. From loans for 150 to 2 million, they have to actually do the certification, but again, they don't have to submit lender documentation. So that's quite a win, in my opinion, for both borrowers and for lenders. The second draw, they've got $190 billion that they're proposing to put towards PPP's second draw loans. Here's one of the stipulations, though. It's going to be employees less than 300, firms that employ less than 300 employees, and they have to demonstrate 50% revenue reduction even in the first or the second quarter of 2020 versus 2019. Now, I think that's a pretty high bar. And I worry that maybe the 50% threshold is too high, and we may miss out on perhaps saving hundreds of thousands of businesses that have been affected, but maybe they've only seen a revenue reduction of 20 to 30%. I think 30% is something that I would push for, and I've actually suggested that to a number of folks because I think the goal here is to try to help as many small business owners as possible. I don't think we need some arbitrary figure of 50%. They've made it ineligible for publicly traded companies. Obviously, there was a lot of PR about that. They've gotten rid of that. They've actually made the maximum loan $2 million. So they've reduced it from the $10 million that used to be in the earlier version. It's now down to $2 million. You may not receive another SBA loan that aggregates to an excess of $10 million. That's another little peculiarity here. The forgiveness, again, is still the 60% payroll, 40% other, and obviously they've expanded some of the other as I just talked about. Lender compensation. They have reduced lender compensation, which I'm sure a lot of folks on the audience are not terribly happy about. It's now for loans up to $350,000, it'll be 3% and 1% thereafter, or above that figure. I think that's fine in some respects because these are probably going to be clients that you've already got, okay? So you don't have the costs of going out and acquiring that customer. However, I think they ought to put some guidance into reducing the application process for this second draw of a PPP loan. And unfortunately, we don't have anything yet in this proposed bill about that, but hopefully that's coming. They are also saying that standard procedures of the normal 7A are going to take precedent, and they're going to encourage that to the maximum extent possible. Now, I don't quite know what that means exactly, but I guess we'll hopefully flesh that out in the regs. They, as I already said, they're going to reduce the maximum loan from 10 million to 2 million. They're going to allow borrowers who already have a PPP loan to go back and actually, because of changes to the interim final rules, they're going to be able to increase their loan amount accordingly if it turns out that they should have gotten a larger loan in the original. And then the big thing, I think, for most folks on this call, is the new 7A loan guarantee program for recovery sector businesses. And so what this is going to do is take the existing 7A program, and if you meet the size standards, you employ less than 500, you demonstrate a greater than 50% revenue reduction, and this is important, you're either a seasonal employer or your principal place of business and at least 50% of your income is derived from a low-income census tract, then you'll be eligible for this, okay? Now, you can only do PPP second draw or the 7A program for the recovery sector businesses. You can't do both according to the proposal, all right? And what they'll do is you can get a loan up to 2 times your annual revenue, up to the $10 million, with a maturity of 20 years, okay? And you'll have the borrower will have an interest rate of 1%. Now, this is where it gets a little complicated. They're actually proposing that they take the interest rate, the new, I don't even know how do you pronounce this, the SOFR, the SOFR. I'm not really sure if anybody's coalesced around how we pronounce that acronym yet. But the SOFR index plus 300 basis points, SBA will be, which by the way is like 3.1%. That would be the interest rate. SBA would cover the difference between the 3.1 versus the 1%. There's 100% government guarantee on this. The borrowers will be able to use it for working capital, acquisition of fixed costs, or refinance existing debt. There's no credit elsewhere test. They're going to defer the first 2 years of payment. There's no borrower fees. There's no lender fees. You have to apply by December of this year to get one of these. The SBA is being advised that they have to issue guidance on the secondary market of these loans within 60 days of enactment. Of course, the question is there going to be a secondary market for these loans? I think there may be, but if you think about a 20-year T-bill right now is 1.03% as of yesterday. Probably that's how the secondary market ought to look at these, because they're going to be getting 3.1% for still 100% full faith and credit of the U.S. government, 20-year term. Maybe there's going to be a secondary market. I guess
I think there will be a secondary market, but it's certainly not going to be the premiums that you would get a normal 7A loan. And maybe we're talking some sort of haircut.
Yeah. Oh, I think there's going to be a pretty dramatic haircut. I don't want to go on a limb here and guess what it'll be, but it's definitely going to be in the single digits, I think, at least.
Let me bring Katie in here real quick. Mm-hmm. Katie, this is a proposal. So where do we go from here? The first question I have is, do we have bipartisan support of this? Is this going to fall in line with previous stimulus type of programs?
Well, from what I've seen so far, this bill was proposed primarily by Republicans in the Senate, and I have seen a little bit of pushback. I think all they want to do is maybe tweak some of the wording on it, make sure that everybody agrees, but everybody does want to pass some version of this. And there's a lot of pressure to pass that before the summer recess. So I think they're all just trying to tweak it and get it out there.
When is the summer recess, Katie?
That'll be August 10th.
August 10th through Labor Day?
September 7th.
Yeah, just after Labor Day, they come back.
Katie, what percentage, there's 5 million of these loans, what percentage of the loans will be affected by the $150,000 documentation-free aspect?
The House hearings a couple weeks ago have all kind of speculated on this. I don't think we have an exact number. I've heard somewhere between 80 and 90%. And I've heard various things on that. I've heard it even clear up to 93% was the highest I heard. So it is a significant portion either way.
Chris, are you going to be funding these type of recovery sector loans? Are they attractive enough for you as a lender?
Well, I think we will be. The short answer is I think we will be, but I think we need to know a lot more information about it. I hadn't even gotten to the lender compensation on these loans. They're going to do the same 3% up to $350,000 recovery sector loans, and then 1% above the 350. So it's okay. But having 2 years of deferment, that'll stress a lot of smaller institutions. So the secondary market component will be pretty critical of this. Having the SBA pay that delta between the 3.1 today versus the 1% on these loans, I think that'll be interesting to see how that shakes out. And then obviously being able to sell these loans in the secondary market, even if you only get a few points on this, I think that's going to be important for liquidity purposes. So we'll see. I mean, there's a lot more to be learned on these things.
Chris, I apologize. You may have covered this, but we can go up to $10 million. Are we able to get a traditional 7A loan or a 504 loan with that $3.5 million cap?
We don't know that yet.
Okay. All right.
What was said earlier was that on the PPP second draw loans, you can't aggregate in excess of $10 million. So I suspect that'll probably, when we finally get the regs, that'll probably play out here as well. Given that 7As cap out at $5 million now, a lot of us who've been in the industry for some time were kind of scratching our heads back in late March, early April when they were going to go up to 10 million to begin with. So I don't know that the agency would want to go beyond that, I suspect. So anyway, so that's what's going on with this stuff. I mean, there's a few more things in here. They're going to finally let, chambers of commerce be eligible for these loans. There's some guidance in terms of trying to prioritize underserved communities. The biggest concern I have with the recovery sector business 7A loans is that it's just focused on those seasonal employers and those in the low-income census tracts. I think that's going to probably restrict millions of small businesses from being able to.
What was the rationale for revenue reduction?
Well, I think they want to try and help those who have been hurt the most, and I don't think that common sense that's a very noble thing to try to do. But how do you tell the local restaurant that's seen their sales go down 41% that they're just not eligible, and too bad, they've got to go out of business? I think there needs to be a little more loosening of this revenue reduction threshold, just like I think they really ought to expand the eligibility for the 7A recovery loans. A 20-year loan at 1% to the borrower where you get the first 2 years deferred, that's a significant debt instrument. And it's the kind of thing that we've been talking about for months that small businesses are going to need. PPP is, yes, it's helped in terms of keeping some workers on your payroll and maybe covering some operating expenses. But at the end of the day, we've got a big hole to dig out of. And I think working capital is a critical missing piece that you're not going to be able to offer to businesses under normal 7A structures, because among other things, when you're looking historical at underwriting, you have to meet the SBA's minimum debt service coverage requirements, unless they give us guidance to throw out what I call the quarantine quarters, which is Q2 and Q3. If you can throw them out, maybe you could apply normal 7A underwriting to help some of these and do some working capital loans. But I think this proposal is significant. I just want to see more businesses be able to take advantage of it so we can hopefully save millions more of small businesses.
Very good, very good. I think what we're going to do is we're going to cut off the presentation here. We'll pick it up again tomorrow. Chris, are you available tomorrow? You want to come back, or we'll talk? We'll talk.
I think so. I think I can make it work.
Okay. Well, we'll see what we have on that. Hey, we have a Coleman webinar on Wednesday. Lance will be doing that. He's going to be talking about the specifics on how to do a loan forgiveness application. We have enough information between all of the stuff that's been coming down to be able to put something into context for you so you clearly understand what is happening. And with that, Chris, thank you so much for joining us. I appreciate it. Very nice, succinct presentation. Katie, is always good to see you. And thank you for joining us today for Coleman Report Live and for supporting America's Main Street, one entrepreneur at a time.
Have a good day.